Hello, audience. In the context of the U.S. economy showing signs of slowing down, inflation remaining high, but the labor market weakening, the Federal Reserve, Fed, has just decided to cut interest rates by 0.25 percentage points. The question is this move just a normal adjustment, or does it conceal greater concerns about the U.S. economy? How will financial markets and the people be affected? Note that this information has been compiled and gathered from various sources as well as personal experience for the sake of analysis, so if there are any mistakes or corrections needed, please kindly comment below. This video is for analysis and reference purposes only and does not represent any political or media organization. Recently, the Fed has just cut the benchmark interest rate by 0.25 percentage points, the first adjustment since the end of 2024. This decision was called a risk management step by Chairman Jerome Powell in the context of U.S. economy slowing down, the labor market weakening, inflation still higher than the 2% target. This move sends the signal that the Fed wants to proactively respond to the risk of economic downturn while still staying cautious against inflationary pressure. This rate cut decision by the Fed is not a sign that the U.S. has officially fallen into recession. On the contrary, it is seen as a precautionary step. Jerome Powell and members of the Federal Open Market Committee, FOMC, want to avoid the scenario of employment declining too quickly, which could directly harm the lives of tens of millions of people. When the labor market is the pillar of the economy, any sign of weakness carries the risk of spreading to consumption, which accounts for up to 70% of U.S. GDP. Therefore, the Fed has chosen to slow down monetary policy to create a safety buffer instead of waiting until a real crisis erupts. Major news outlets such as Reuters and The Guardian assess that this move shows the Fed is worried in advance about the outlook of the labor market. They believe Powell wants to send the message the Fed is ready to protect jobs, but at the same time not overlook inflation risks. Some commentaries emphasize that this is not necessarily an admission of recession, but a sign of caution. The Fed wants to act before the situation worsens, rather than being forced to make drastic cuts in the future. Many Asian experts, especially in Japan, South Korea, and Singapore, believe that this decision has a spillover effect. When the Fed lowers interest rates, the pressure on central banks in the region also decreases because the interest rate gap with the US dollar is no longer too large. This may allow some Southeast Asian countries to breathe easier in monetary policy without being too stressed about maintaining exchange rates or attracting foreign capital. However, some other experts warn, if the Fed moves too quickly in the easing cycle, the USD may weaken sharply, creating major volatility in the foreign exchange market, especially for countries with high levels of debt denominated in USD. For American people, interest rates on home loans, car loans, or credit cards may decline slightly. This helps reduce monthly spending pressure, especially in the context of living costs still being high. But there is still a concern. If inflation persists, lowering interest rates may cause the prices of goods and services to remain expensive. Workers will fall into the situation of borrowing more cheaply, but goods still not getting cheaper. In addition, although the labor market has weakened, it has not collapsed. This makes many Americans question, is the Fed acting too early, and is there a risk of adding fuel to the fire for inflation? If viewed as a whole, this is a dual balance strategy. On one hand, the Fed is being softer with the economy to avoid a sharp rise in unemployment. On the other hand, the Fed still maintains a tough stance if inflation does not fall back to the target level. Powell calls this a risk management step, meaning the Fed wants to keep control. Instead of passively waiting for bad data to react, they cut a small step in advance, both to reassure the market and to have room for adjustment in the future. From a neutral perspective, we can say the Fed is trying to walk on a thin wire. Cut too fast, the risk of inflation returning. Cut too slow, the risk of unemployment weakening deeply. Now we will discuss the impact and consequences.
First, within the domestic scope, Americans will feel the most in credit costs. The Fed's interest rate cut helps mortgage rates, auto loans, or credit cards cool down somewhat. For many households already under pressure from high living costs, this move can be seen as a temporary painkiller, helping them breathe easier. However, this impact is not uniform. Those who need new loans will benefit significantly, while those who already borrowed at fixed interest rates previously will hardly see any change.
On the financial market side, U.S. stocks may react positively in the short term. Interest rate-sensitive sectors such as real estate, banking, and consumer goods will usually benefit. However, on the other hand, investors still worry that if inflation is not cooled down, the Fed cutting rates too early may stimulate spending and push prices back up. That means the market still carries risks of instability in the medium term. Next, regarding the world. One obvious effect is that the U.S. dollar may weaken slightly. When interest rates in the U.S. fall, U.S. Treasury bond yields become less attractive, causing global investors to tend to shift capital to other markets. This helps emerging economies reduce pressure to maintain exchange rates, while also having more opportunities to attract additional investment capital. However, this shift is not entirely favorable. International capital flows may pour into markets with high real interest rates and stable investment environments, but can also leave quickly if volatility arises. Countries heavily dependent on foreign capital still have to remain cautious. In addition, countries importing goods from the U.S. may benefit when the USD weakens, helping import costs become cheaper. But the big question is, will global inflation actually cool down? The answer may not necessarily be yes, because energy prices, raw materials, and transportation costs remain unpredictable. If U.S. inflation only falls slowly, the positive spillover to the world may be limited. Thus, the Fed's decision to cut interest rates brings two sides. For the U.S., it supports spending and credit, but still comes with inflation risks. For the world, it may help ease exchange rate pressure and create opportunities for capital flow shifts, but it does not necessarily ensure that global inflation will cool down. This impact is like a double-edged sword. It provides necessary short-term support while opening up many big questions for the medium and long term. The Fed's decision to cut interest rates by 0.25 percentage points shows that they are following a risk management approach, not reacting in panic. However, the real impact of this move will depend on whether inflation continues to decline and whether the labor market stabilizes again. So, in your opinion, is this just a small adjustment or a real turning point in U.S. monetary policy? Leave a comment to discuss.